Hi, it's Deanna with Community Lending. I'm joined today with Amanda Conder Miller. She has been a loan officer here at Community Lending for 10 going on 11 years now.
Yeah, 11 in November.
Yeah. So we have been together for a very, very long time. And she and I are going to talk about the 10 most common myths we see in mortgage lending today. So there's a lot of that going on, a lot of misinformation, just people Googling, right?
And I gotta love the internet. There's a lot of misinformation out there on the internet. And I think that it's important for consumers, home buyers, anybody out there really to understand the fundamentals of mortgage.
Yeah.
Yeah.
So we're going to go over a few of the ones we see most often. I think the first one that comes to mind for me is that most folks think you need perfect credit to get a home loan.
Yeah, and that's not entirely true. Let's take FHA, for example. FHA's guidelines, their rule that they set is a minimum of 580. It's always best to check with a lender to find out if they have any additional rules in that space of like how low that they can go. But a 580 credit score, and then let them take a look at your credit and go through and make sure that everything is where it needs to be.
Yeah. So I know I've seen a lot of credit reports, and I'll hear people say things to me like, well, I have some medical collections, so I know I can't get approved. And that's one of the biggest misnomers is if you have medical collections, it might affect your score, but it doesn't necessarily affect your ability to get a home loan.
Yeah. And as lenders, I mean, we don't necessarily look at the medical collections. So we just kind of dismiss them. And we don't look at those. What we do look at is the bigger collections, and in our guidelines, we have a very select verbiage that we pay attention to when it comes to that. But medical collections are not one of those.
What about charge-offs?
Charge-offs, depending on the program, is going to depend on whether or not we can just let those go as well.
Yeah. So if something's charged off, it's put behind them. The original creditor has wrote it off as a bad debt. So if you have maybe a car repossession from 5 years ago and you see it charged off on your credit report, you can qualify for a home loan if everything else works out. And I think so many people think, oh, I've got to wait for everything to actually fall off my credit report, but that's not really the case.
And the key word there is charge off.
Yeah.
Profit and loss write-off as well.
Common misnomer is that, if I get my credit pulled, it's going to tank my score, and then all of a sudden I don't approve for anything. But that's not the actual case, right? So a lot of times folks are going out and they're shopping for a mortgage. That first credit pull could ding you a little bit, but during in a certain period of time, what you'll find is that the algorithm protects the borrower from having their score drop when it's the same type of credit pull, so i.e. mortgages.
Yeah, so when let's say you go for a second opinion with another lender, your score shouldn't drop because in that algorithm, it's recognizing that you're shopping for that particular product.
Correct. But now one thing we have to consider is that, I'll hear this a lot too. Like, well, you pulled my credit and it dropped. Well, we've got to talk about what else did you do that could have caused that drop. So, in some cases you've gone to Kohl's and they said, hey, we're going to give you 10% off if you apply for a credit card. And then you go out the door and you're maybe over
go shopping for a new car.
Yeah. Or JCPenney's, or I'm going to get 10% off on TJ Maxx. So too many credit inquiries definitely will impact your score. But if it's isolated, you should be okay. So that's one of the first ones. Number two, I hear a lot is if I'm self-employed, it's going to be harder, or I can't get a home loan. Is that actually the case?
No, obviously as a self-employed borrower, if you do own your own business, it's obvious that you keep good record keeping files for yourself. And it may have been true several years ago that it was a little bit harder because they were really looking at different factors when it comes to a self-employed borrower. But today, in today's lending, you have several different outlets for a self-employed borrower, bank statement loans, a lot of portfolio products. And when we say portfolio products, we mean the specialty products.
Yep.
You have your bank statement loans, you have your investment loans, several different types of loans that will allow a little bit more leniency for a self-employed borrower. 1099, if you are working for a company and they 1099 you, that's considered self-employment.
And the agencies themselves have even relaxed a little bit. So when I say agencies, I'm referring to Fannie Mae and Freddie Mac. They'll allow for a 1 year of tax returns if the business has been in existence for over 5 years. Mm-hmm. So that's something to consider. I think the best thing to do if you're self-employed is to seek out the help of a professional and have them look over your situation and decide if they can help you with one of the portfolio products, or in best case, send you through Fannie or Freddie, right?
Right. Yeah. Definitely.
So here's another fun one. And I love this one because I get this one all the time. Well, I don't really see a point in getting pre-approved because I haven't found my house yet.
Until I find a property.
So
yeah,
that makes me giggle every time, because so now you found the property and there's all of these homeowners making bids and you're scrambling to get the lender what they need to get your pre-approval. So it's the best practice would be to get that pre-approval in place, right? Before you go shopping for a home. This way, you know what your budget is.
Right.
You know what your budget is. You know what your payment is.
You know what you qualify for.
You know what you're qualified for.
And if circling back, if you're a self-employed borrower, it's not as, it's a lot more paperwork. So now you're scrambling to get this paperwork and trying to bid on this home. And you have there's that chance that you'll lose out on that home just because we weren't prepared.
Yeah. The other thing to consider too is in the market that we're in right now, there's a lot of competition. And so sometimes it's best to go ahead and get actually underwritten before you go shopping for a home. So now you're going in with a commitment versus a pre-approval, what's the difference between those two, Amanda?
The difference between the two of them, you have your pre-qual, which is someone who's just basically taking a look at your credit, taking your information in and saying, everything looks good. I'm going to go ahead and issue this, which it's not necessarily worth the paper it's written on. You want to find somebody that's going to ask you for the documents and review them, where your pre-approval comes in. They've already reviewed your credit. They reviewed your documents, your tax returns, whatever paperwork is necessary for you and your circumstances or your, financial profile. And then the next step is loan commitment. And that's where we've packaged this up. We've agreed that this loan is doable. And then we put it in front of an underwriter. And that underwriter makes the credit decision. And with that, it takes out the guessing of whether or not you're going to qualify.
And in a lot of cases in this market, you can then waive your financial contingency
on the contracts
and the contracts and compete with cash offers. So that's a really good way to get that offer accepted.
And
and at Community Lending, one of the things we do that not everyone does, there are some programs out there, but we put $5,000 behind that and say, if we issue a loan commitment and you go shopping for a home and for some reason you actually don't close, we're going to pay the seller $5,000 just because we failed. And our goal is never to fail. So that's a great way to get those offers accepted. So that's one thing that we've talked about. Now, number 4, this is a good one. It's cheaper to rent. So that might have been the case at some point if you were only looking at what it cost you per month, right?
Mm-hmm.
But I think what people don't realize is the appreciation that happens when you buy a home and what that leads to long-term. And the number one way people build wealth in this country is through home ownership. Now, recently, we've seen some crazy things happen with rent. So I think U.S. rents say they've gone up 17% year over year. And in some pockets of Florida where we're at, 30%. So it might just be cheaper monthly to buy a home versus rent a home in our area, right?
Mm-hmm. Yeah. I've seen it time over time. A couple clients, come in and they're paying double what their mortgage would look like.
Yeah.
And they're so stoked whenever they get into their new home because now they're saving close to $1,000 to $1,500 a month just by buying a home.
Now, how does that play out? We've seen rates go up, prices are up, rates are up. Is it still cheaper to potentially buy versus rent right now?
I think it is actually. Yeah. When you look at some of the numbers and some of the statistics, it's obvious that, rents are still incredibly high
And still going up,
and
right?
still going up. Yeah. And in that space, you're talking about, if you're renting for $1,000 a month, which is not possible in our market right now, that's $12,000 a year. What can you do with $12,000 if you own? You're bringing your principal down.
Bringing your principal down, and you're getting the appreciation. So even if appreciation slows, would you rather pay off your own mortgage or your landlord's? And I think that's the miswiring that some folks have when it comes to renting. You're really just burning money in an ashtray. It's not going to benefit you long term. The long-term investment or the long-term play is definitely to purchase regardless of where rates are at today. And then we talk about, you hear a lot of people say, well, the market's going to crash. The market's going to crash. We're going to see 2008 all over again. And the truth is, no one really knows.
They did not hand us crystal balls when we got our mortgage license.
No, they didn't. I'm on the side that I believe that we might see a small market correction, but I don't think it's going to look anything like 2008 because the products that existed in 2008 aren't here today. People buying homes today are putting good down payments. They're going through rigorous, they're going through regulations. They're going through rigorous underwriting. It's not the same as 2008. So I'm of the school of thinking that we might see the market flatten a little bit. We might see a small correction, but we're not going to see a long-term blowout like what we saw in 2008. That's just my personal opinion.
And I would have to probably agree with you, just because also you have to take into consideration supply and demand. In 2008, the supply was crazy that houses were going up on every other lot, and that's not entirely the case now.
Yeah.
So your supply and demand is really what's driving the market right now.
Yep, I agree. So number 5 on our list of things is you need a minimum down payment of 20%.
Yeah, this one's my favorite myth. This one is my favorite myth because that is not true. Most programs today will allow for as little as anywhere from 3 to 5% down. What the 20% marker does for a consumer, a buyer, is eliminates the need for mortgage insurance. And mortgage insurance essentially just protects us, the lender, against any default.
Yep.
And in that case, is it nice to not have that mortgage insurance? Obviously, yes. But you don't have to have 20% down.
Yeah. So with FHA, it's 3.5%. And then there's the 100% programs. Like if you're a veteran, you can get 100% financing.
And they don't have mortgage insurance.
They don't have mortgage insurance. Exactly. One of the other things that we don't talk about a lot is the fact that there are down payment assistance programs. In fact, Florida came out and we did a podcast last week about it, Hometown Hero Homes. And that's huge.
That's a great program.
But I thought the coolest part was the expanded income restriction. So you can make up to like $120,000. I think it is in this county. I'm paraphrasing.
118.6, I believe.
Yeah. So, call it 118. Yeah. And then on top of that, it's like 50 different professions that fall into that. You can be a massage therapist and qualify for the Hometown Heroes program. So with that, you could come to the table with nothing out of pocket. So, that misnomer, you got to put 20% down. Not true. You can put as little with FHA as 3.5% down. You can use USDA in some areas, 100%. You can do VA, 100%. Or you can use a down payment assistance program if you qualify. So if you don't have the money to put down on a house, it's still worth a call to a lender to just look at your credit profile, look at what you've got going on, and decide if you fit into any of these boxes that could help you. So definitely don't need 20% down.
I have one for you.
I know. She's going to hit me with this one.
The lowest rate is always the cheapest option.
That is so not true.
Tell
not true.
Why.
I'm going to tell you why.
Tell me why.
I'm going to tell her why. So yeah, the cheapest rate is always the best option or the cheapest. And that's so not true. What most folks do is they get on the internet and they type in, lowest mortgage rate, and they look at it and they're like, yes. But what they're not looking at is the APR or what kind of points are associated with obtaining that loan.
That fine print is
The fine
it's
print.
at.
Yeah. And I could on one of these podcasts, I'd love to take you through some of the websites that hide the detail. So you're looking at just, hey, that rate is half a point less than maybe community lending offered us today. But what they're not reading, or that you don't see because it's hidden, they hide it to make it hard to see, I think purposely. I don't think it's right. But is that you're paying points. And so if you're not looking for, or you're not trained to look at what happens in a situation like that, you could be paying 1, 2, 3 points for your property, which equates to, what is a point? A point is 1% of the loan amount. So if you're borrowing $300,000, 1 point is $3,000. So if you're paying 2 points to get the lowest rate on of the day, you're really paying $6,000 in additional closing costs to get that loan. So that's cash out of pocket at closing. So what makes paying points right or wrong is really what your personal goals are for the property. So if you're a traveling nurse and you're moving to Fort Myers for 2 or 3 years, and your plan is just to buy for right now and then sell,
Do the points make sense?
the points don't make a hill of beans of sense, because at that rate, you're never going to realize your money back. You're not going to earn it back. So what we look at is, we're going to look at what your plan is for your life. We're going to see, are you going to keep this house for 5, 10 years? Are you going to break even and actually start to realize that savings? Or is it better to just pay the higher rate? So those are things that the professional can walk through with you and show you the comparisons, and then let you choose which one's best for your situation. But the cheapest rate isn't always the best option given your personal situation.
You always have to look at the fine print, because that fine print might say that you have to put 25% down with a 780 credit score. And that might not be what we're working with.
Yeah. Or that it's a single family residence versus a condo. So a lot of different factors go into pricing a loan. So you've got to consider that you've got to have a credit score of over 760 to get the best tiered pricing. You have to be buying a single family residence. It has to be your primary residence. So all of those things bundled together then represent the risk that's being put before the lender. And that's how they decide what the rate is going to be.
And a good loan advisor is going to be able to show you those items.
Yep, absolutely. So one for you here, you need to be on your current job for at least 2 years before you can qualify.
No, not entirely. What most lenders look for is a 2-year job history.
So what you're saying is, if I've been at community lending now for 11 years, and I leave community lending and I go work for Timbuktu Mortgage, do I need to be at Timbuktu Mortgage for 2 years to qualify?
No, as long as you don't have a gap.
So what happens if I have a gap?
Then you probably, I believe that it's 6 months.
Yeah. So I think the way it works is, if they have a gap greater than 6 months,
You have to have 6 months on the job.
yeah,
Show 6 months.
I'd have to double check that. I'm getting dementia in my old age. Seriously. So I'd have to look, but yeah, if there's a gap, I think it's longer than 3 months actually, then you have to be at your new job for at least 6 months to qualify. But all the same,
Yeah.
you don't have to be at your current job for 2 years, as long as you have a continuous 2-year work history, right? Wow. So that's a lot of really good information if you're a home buyer that's been told misinformation, or maybe you Googled and read something just to check into. So number 8 on our list is, the 30-year fixed is always the best option. What say you, Amanda?
I think that depends on what your goal is, what your financial goal for your future is. If you are buying a second home and your goal is to pay it off in 5 years, that 30-year mortgage might not be the best option for you.
Yeah. And because early this year, Fannie Mae and Freddie Mac came out and said, we consider second homes a little riskier and we want to mitigate some of that risk. So they applied what's called loan level price adjustments. And so now when you're buying a second home, the pricing's higher. So in some cases, a 7/1 ARM could be a great solution for a second home buyer looking to purchase in Florida, knowing that 5 years from now,
5 years, they're going to pay it off.
they're going to pay it off. Yeah.
Right.
So that's definitely something to consider.
And I think that it's important to point out too, that the ARMs are not let's just go ahead and clear the elephant in the room that the ARM loans are not bad loans.
No.
And basically what the ARM is it is an adjustable rate mortgage. However, it's fixed for 7 years. So if you're going to pay off your home in 5 years and you have a 7-1 ARM, you're going to have a fixed rate for 7 years.
Correct. I think a lot of that misnomer comes from 2008-9. There was a loan product called a negative amortization loan, NEGAMs. I was around during those, and
I've heard about them.
Yeah, they're terrifying. And so those loans, actually, what would happen is they'd qualify somebody that really couldn't qualify for the loan, and instead of paying the interest every month, the interest was tacked on to the back of the loan. So instead of their principal going down, it was going up. Since those days and what happened in 2008, those loans don't exist today.
So your
traditional ARM is back, and it's a very viable solution for those that are looking for a different way to finance and maybe save some money on those loan level price adjustments. So I would look at both a 30-year fixed and a ARM loan if I was buying second home in Florida, and decide which one works best for my situation.
And didn't we do some research not that long ago that state statistics show that people stay in their homes an average of 7 years before they sell?
That's right. That's right. So especially here in Florida, lots of transient, move up, move around buyers. So if you're thinking to yourself, I know I'm going to sell my house up in Minnesota in 5 years, it makes sense for them to go ahead and pay off, or to use an ARM and then pay it off,
right?
And realize that savings. Here's another one. And this one comes more for me from a realtor perspective. I hear a lot of realtors say, oh no, you can't get a condo with less than 20% down. And that's a huge misnomer, especially now because prices are so high. That some of our first-time homebuyers are resorting to buying a condo to get in the real estate market game, to get their first home, to get their their foot in the door. So there's a lot of condos, and what dictates what you put down on a condo is really the program. And does it meet the condo association? Does it meet the program guidelines, right? Mm-hmm. So you could put as little as 3% down on a condo, as long as the condo association themselves qualifies for Fannie Mae or Freddie Mac. And even better, FHA now does spot approvals for condos. I just closed one recently where, they were blown away that we could get it done, but that's an option. It's a little bit more clunky as far as our side is concerned.
Yeah.
But it's an option to put as little as 3.5%.
Super exciting that FHA is allowing the spot approvals.
Yeah. So, there are options for condos way less than 20% down.
Yeah. And I think it's important to point out that with condos, if you have less than, there's two levels to condos, and one is what Fannie Mae and Freddie Mac would consider a full review. And that's a full review of the condo association's financials. They want to make sure that the HOA and condo associations are financially stable and they're holding enough reserves in certain places. And I think that in reserves, they have a little safety net per se, in case something happens, because with condos, it's the association that's responsible for the structure of the building.
Yeah.
So
and all those common areas too.
Yeah. So if something's wrong with the structure of the building, the reserves is usually kind of what helps take care of the emergency there.
So we're looking at not only the borrower, but we're also looking at the financial strength of the homeowners association or the condo association themselves, to make sure that they have the wherewithal to withstand maybe having to put on a new roof, or maybe
roofs are big in Florida.
Roofs are big in Florida. So when you're buying a condo, there's really two underwrites happening at the same time. We're underwriting the borrower, but we're also taking a deep dive on the condo association. So if you're a realtor or you're a buyer and you're thinking about buying a condo and you have a specific condo in mind, what's the first thing you should really do is reach out to a loan officer and find out whether or not we've previously approved there, see if we can get our hands on the budget, the balance sheet, the insurance, and make sure that things look good. There's some more I's we have to dot, obviously, and T's we have to cross after you get you get a contract, but gets us going, right?
Yeah. And Fannie and Freddie have a whole list of associations that are approved, projects that are approved. FHA, VA, they both have a list of condominiums that are approved as well. And if they don't happen to be approved, that's when we come in and look at the budget and the reserves and the insurance and all of the good documentation that we need for the condo association to make sure that it's financially sound and that we're going to be able to pass underwriting.
Yeah. And I think a lot of people think it's terrifying to buy a condo, but the truth is it's not nearly as bad as it's been made out to be. And it is an affordable option for those trying to get into the market and maybe don't have the budget to be able to buy a single family residence yet. So great way to get started. Here's the final one, number 10. And I hear this one all the time. And I don't think I've heard anyone else highlight this in their mortgage myths, but you can't qualify for a home loan if you have student loans.
Dun, dun,
Dun,
dun.
dun, dun. So true, false?
That's false.
Yeah, it's false.
That's false.
False. So there's a lot of changes that recently happened with student loans because student loans in the past could prohibit you. There were some really antiquated rules about, you had to take 1% of the total outstanding balance and, use that as a liability on the application. And that didn't always work out. But recently we've seen some relaxing in that space. And we've seen where FHA now says you can use an IBR program. And if you don't know what an IBR program is, it's income-based repayment.
Yeah.
If you have an income-based repayment plan and it is $7 a month, we can use that $7 a month. So that really opens up.
It's huge.
It's huge. It's huge, Carolyn. Huge. Yeah, it's definitely huge.
I mean, that $7 outbeats your 0.5%, your 0.5% that FHA actually recently went down to. They were for a long time at 1% of the balance. And now FHA has moved to 0.5%. Freddie Mac, 0.5%. Fannie's still hanging on to that 1%. But yeah, the student loans don't have to
necessarily be a problem.
Yeah.
And then, I didn't put this one on our list, but as I was sitting here thinking, another thing that I hear a lot of is, I don't qualify. There's nowhere for me to go. I can't, I don't have the money I need. I need a cosigner and I don't know what to do with that because it scares me. Remember, you can use a cosigner. So you can have a cosigner, mom, dad, brother, sister can cosign for you and just make up that difference in what you might be short debt to income ratio wise, right?
Mm-hmm.
So that's another option for folks that are near misses and maybe want to get in the game, but might just miss it by a hair. They can add a cosign. So gosh, that was a lot.
Yeah. There's a lot of myths out there. We probably covered half of them.
Yeah. So Amanda, thanks so much for joining me today. We're going to continue this podcast. We've named our show More Than Mortgage because one of our goals is to highlight local businesses, local charities, and talk about more than just mortgages. So tune in, subscribe to our channel, and stay tuned for next week's podcast.